Okay, thanks for joining me today. I'm going through AQA ACCN3 June 2014, specifically Task 2, which is an incomplete records question. It was requested, so if you get your own requests in, hopefully I can make videos on it. Next video will be inventory valuation, so AVCO and FIFO. But firstly, I've had exams recently, so I've not been able to upload at all in the last month or so, however long it's been. So my apologies, but over summer, September, October, up until January, I'll be uploading as much as I can. And yeah, also I don't know why the videos aren't uploading in HD recently. I'm trying to figure that out. It's been a bit poor quality, but anyway, let's get on with the video. So incomplete records, basically they give you some information. You've got to find some missing values, fill in the blanks, and then they'll ask you to do something with them values. So here they've just told me to prepare an income statement. A balance sheet is not required. So basically, already you can see I've drawn some T accounts just to make the video shorter and a bit quicker. But if you understand T accounts, you can just fill in the blanks. Really, it's brought down, carry down. It might give you one or two transactions in between them two, brought downs and carry downs, and then you just fill in the blank. Basically, that's all it is really. So I'm going to start off with the first thing in additional information number 1, which is the cash in hand. So I'm just going to make a cash T account, and we've got a brought down on the debit here of £500. It will always be on the debit because you can't have negative money. You can have a negative bank account, but you can't have negative money because cash in hand is money in your pocket. You can't be negative in that, in a sense. So the brought down is 500 and the carry down is 600. So what I can do here is just put that as 600. Okay. So what I'm going to try and find here are the cash sales. Well, all sales are on a cash basis, so that's what we're going to try and find now via this cash account, because if we're making sales on cash, it's going to go through the cash account, and we don't know what the value is, so we're going to find that now quite easily, because all sales go through the cash account. So I need to plug in things on this side, cash out, which therefore will leave me with a value on here that makes up the same total for both sides in a sense. So first of all, what you can notice from the bank account is we've banked 96520, so we've took money out of our pocket and just put it in the bank. So that's going to be out of our cash account. Think of it, we have to have a debit and a credit for every transaction. We've got a debit here in the bank account, so we're going to have a credit in the cash account. So that's going to be 96250. Also, additional information 3, we're given sales receipts have been banked. So what does that mean, banked? Well, it just means we've turned cash, well, money we had in the pocket, and we just put it into the bank. So in a sense, it's left our cash account. So what we can do in a sense is just put these 3 values, these 3 values into our cash account. Drawings and purchases. So just got to put them values in really. So just 900. 18,000 and 8980. Okay, so I've just lifted the values from part 3 or information 3 and just lifted them into the credit of my cash account. So that comes to, I believe, 125,000. So the total of all them is 125,000. So in a T account, obviously, we need both sides to equal each other. So the missing value here is going to be our cash sales. The thing that increases our cash when we sell an item is going to be cash sales. So basically, 500 plus the cash sales equals that. So this is obviously going to be 124,500. So basically, what I found there, I've just found my revenue figure. And the revenue figure in the income statement. So basically we found the first part already of our income statement. So what's the opposite of a sale? Well, it's a purchase. So why don't we try and find the purchases? So what we have is we're given trade receivables, and we have trade payables. Sorry, we're given brought down and a carry down for it. And we're also giving payments, because that's cash out of our bank account, so it must be payments to our trade payables. So therefore we can find out what our purchases are, can't we? So if I make a trade payables T account, So trade payables is a liability, so the brought down is always going to be on the credit, and the brought down was 7700, which is our value at the 1st of April 2013, the start of the financial year. And what I know is the carry down will be 5600. Okay, so this side will increase our trade payables. It will increase our liabilities, increase how much we owe. So if we're paying them, like we are in our bank account here, we're paying them, we're decreasing the amount we owe, because we've given money to them. So we can just put here, payments made. It should say bank, but it's easy to explain if I say just payments made, in a way. So that's going to be 90525. Now, that side will come to 96125. So, as we know from the previous T account, we need the two sides just to equal each other. As you can also, we've not had any returns, have we? It doesn't state any returns, so don't overthink things. In incomplete records, they're only going to really give you the basic things. So if they're giving trade payables, they're just going to give you purchases and the payments made, really. So I can conclude that this side's only going to have payments made and a carry down in a sense. So what increases our trade payables? Well, it's going to simply be our purchases. So we need the two sides to equal each other. So it's going to be this minus our 7700 is going to be 88245. Hang on though, what's this? That's our credit purchases. But we also have some here. 8980. So our total purchases, this is the value that will be going in our income statement, comes to 88245 plus 8980, which is 97405. Yeah, that's right. So what else? So basically what I'm going to try and do, I'm sort of working down the income statement. So I've started with revenue, and now I'm into my cost of sales of purchase. So why don't we try and find the inventory now? So opening inventory, they haven't given it us, sadly. The inventory at the 1st of April 2013 was not recorded, so we don't have an opening inventory in a way. So it was not possible to value inventory at the 31st of March 2014, so we don't have either. We don't have the opening inventory or the closing inventory, which is shown here. We have neither. However, inventory was valued at the 4th of April 2014, so just a bit before the closing inventory date, where it was valued at 9,400. Goods have been sold on the 2nd of April 2014 for 3,800, and goods have been purchased for 3,750. Okay, so what I'm going to do is I'm going to start off with my inventory figure at the start. Well, not the start, but the 4th of April, the latest calculation of the inventory value. So we're given these two things here, sales and our purchases. So sales, purchase. They're the only two things that are going to increase or decrease our inventory, aren't they? Unless, I don't know, we accidentally burn some inventory or something stupid. But besides that, once we've dealt with sales and purchase, we're going to find our closing inventory on the 31st of March. So basically, I'll just give you a quick outline. That's the closing inventory. Okay, so the inventory at the 4th of March, they told us it was 9,400. Okay, so there's a little trick in this, that the goods have been sold on the 2nd of April 2014 for 3,800. Okay. Well, what's 3,800 related to? We've sold it for that much. Therefore, that's our selling price, and inventory is not valued at selling price. It's valued at the cost it was for us to buy it at. And the markup, well, all goods are sold to achieve a 25% gross profit margin. Therefore, our cost of sales will be 75% of sales in a sense. So if I do this algebraically, not algebraically in a way, but So if I do sales times by 25%, I will get my gross profit. Therefore, I can just assume that my cost of sales equals sales times by 75%. Because sales, to get from gross profit is 25% of sales. Therefore, cost of sales must be that 75%. So say if you had sales of £100 and you wanted you had a gross profit of £25. Therefore, your cost of sales must be £75 to bring that 100 down to 25 gross profit. Therefore, the actual valuation of these sales should be 75% of the selling price, which is 2850. Purchases, they're fine because we're purchasing it. That's at the correct value. Okay, which way am I going to do this? How am I going to add sales or take away sales? Am I going to add purchases or take away purchases to get to my closing inventory figure? Well, I'm going back in time. So what I'm going to do is I'm going to add my sales on and take away my purchases. In a sense, it's the opposite in a way. So that comes to 8,500. So my closing inventory figure in my income statement will be 8,500. So, basically what I can do now is I can sort of check my answer in a way. So cost of sales should equal my sales times by 75%. So what are my sales? Well, they're 124,500 times by 0.75. This now gives me my cost of sales, which is 93375. Okay. So what's the use of this? Why have I done this? So basically, if you add your opening inventory, minus add purchases, and then minus away your closing inventory, we will get to this figure. Okay. So that's what I'm going to do now. I'm going to try and work that out. So I need 93,375 to equal my opening inventory. Sorry, I'm abbreviating it. It's just making it easier for me. Add my purchases and minus my closing inventory. Okay. So I actually don't know what my opening inventory is yet, so I'm just going to put X for that. I know what my purchases are, 97405. I know what my closing inventory is, 8,500. And that still equals 93,375. If you rearrange that to find X, you'll get your opening inventory is equal to 4,470. Okay, so basically what I've done there is I've worked out the opening inventory by using the gross profit margin in 0.6. So I'll just go through that really quickly again. So I know that my sales times by 25% will give my gross profit. Therefore, my cost of sales must be 75% of my sales. So just by using the sales figure of 124,500, I can find out what my total cost of sales is. That's my total cost of sales figure there, 93,375. Now, I've just put in what will be in my cost of sales. Opening inventory, add purchase, minus closing inventory. So that's just back to ACCN 1, ACCN 2 stuff. I know what my total cost of sales is, I know what my purchases are, and I know what my closing inventory is. So all I need to do is just find out what my opening inventory is, which is X there. I just rearranged the equation and I found out what it is. And that's that basically. So I'm going to quickly move on to the profit or loss on the selling of the non-current asset. So how do I define my profit and loss? Well, profit / loss on a NCA sale equals basically equals selling price minus my net book value. So it's don't really overthink it. It's just the difference between two figures in a sense. So I sold it for 1640. So I'm going through 0.4 here. So I sold it for 1640, and we valued it, but we thought it was only worth 1380. So we've sold it for more than what we thought it was worth. So that surely is a profit. So what will we do with that? We'll just add it to our gross profit because it's an other income. Okay, so we've dealt with the complicated stuff, I'd say, right now. And we just need to move on to the expenses in a way that they've given us. So the delivery vans are obviously going to be calculating depreciation here. We don't really care about what the value is of them in total after the financial year, because that goes in the balance sheet, of course. So we've got two types of depreciation: vans and fixtures. Insurance, we've been given brought down and carried down, so obviously we're going to have to calculate that. And our wages and salaries. Okay, so I'm going to start off with one of the assets. I'm just going to do fixtures and fittings. And I was told at the start of the year they're worth 15,170. So fixtures and fittings are an asset, so the brought down is going to be on the debit, 15,170, and the carry down, the value at the end of the year is 15,096. Okay, so, well, obviously depreciation will be on this side. So this is the thing we're interested in for the income statement. So I'll just put IS in brackets. That's what we want to find. However, if you look at the bank account, we've purchased some. Money has come out of our bank account. Therefore, we've purchased some. So I'll just put here bank, and that's going to be 3,700. We've purchased some fixtures and fittings. So that side will now come to 18,870. So therefore this side will also equal 18,870. And now simply I can just find out my depreciation figure, which is 3,774. So that'll be the expense in the income statement. So we might as well just move on straight onto the delivery vans, because we're in the swing of calculating depreciation. So same thing again. Delivery vans is an asset, so the brought down is going to be on the debit. Delivery vans at the start of the year were valued at 16,440, and at the end of the year they were valued at, what was it, 11,624. So once again we want to calculate the depreciation in the IS. Okay, but also there's one other thing. What did we just calculate down here? We calculate the profit and loss on the sale of an NCA, and the NCA was a delivery van. So what we need to do basically is just get rid of that net book value from this carry down, this brought down in a sense. We've not got that van anymore, so we need to take it away from our total value of vans. We don't have it anymore, so we need to decrease that. So I'm just going to put a disposal, and that's a net book value. So what was it valued at? It was valued at 1380. Yep. So the two sides are going to add up to this 1640 figure that we started the whole T account with. And we just need to calculate the depreciation just by taking our total minus the two other transactions on our credit side, and that's going to bring me to 3436, I believe. Yeah. So let's do the insurance. This is quite a nice one because it gives you the brought downs and carry downs. So insurance, well, what is insurance? It's an expense. So brought down, and the prepayment is 390, and the carried down, still prepaid, is 450. So let's get the simple thing out of the way. In the bank account we have an insurance figure, so we must have paid something for the insurance. So if it's on the credit in the bank account, it'll be in the debit in the insurance account. So I'm just going to put bank, and we paid 6,600. So that brings this side up to 6,990. So now we need both sides to equal 6,990. So basically this figure here, I'm just going to put income statement. The examiner is completely fine with you with doing that. That's what I always did. This is actually the exact paper I did. So yeah, this figure is the exact figure I'll be putting in my income statement, which is 6,540, I believe. Yeah. Okay, on to the final one, which is wages and salaries. So this time, oh sorry, my apologies. The brought down was on the debit of insurance simply because it's prepaid. For prepayment, a prepayment to us is an asset, of course. We paid early, so we're doing well because we paid early. I can't really explain it any better than that. So the brought down's on the debit because prepayment's an asset. So wages and salaries here, they're accrued. An accrual, is it's a liability, so the brought down is going to be on the credit, and the accrual is 1,270, and we're still accrued at the end of the year by even more, which is 1,430. So I'm just lifting the figures out of here at the start of the year and the end of the year. Simple as that. Okay, so same thing again. We've made a payment from our bank account for wages. 14,400. So I'm just going to slot that in there and just total this side up, which comes to 15,830. So the same for both sides. So now this is just going to be my income statement figure again. So once again, it's just finding the missing value in a way. Always 560, and that's all the workings basically. Basically, we've done the cash account, we've done delivery van depreciation, fixed depreciation, just done insurance. We found out both the inventories by using the gross profit margin percentage. We did trade payables earlier on, and we've just done wages and salaries. I haven't worked with telephone simply because we're not given a brought down, we're not given a carried down, no accruements, accruals, prepayments. We're just given a telephone payment figure, so we're just going to treat that as the expense in the income statement. So, with all in mind, I've already constructed the income statement just to save time for you guys. I know you don't want me to just be there writing it all out, because you'll know what it is. So, the revenue figure. So, where are my T accounts? So, revenue and income statement, 124,500. So I'm just going to put that there. My opening inventory I calculated was 4,470. I calculated my total purchases to be 9,745. And I calculated my closing inventory to be 8,500. And that's always taken away from cost sales. So my cost sales figure, well, I already know what it is, don't I? It's 93,375 because I did the gross profit margin calculation. Sorry about that handwriting, that's horrendous. So I'm just going to do my revenue minus my closing inventory, which comes to 31,125. 31,125. But in a sense, we already knew that. We knew that revenue times by 25% gave us that. I know I've not put that down, but we knew that in a sense already. And we have a profit on a disposal. Where is it? There, right at the bottom. We have a 260 profit. So I'm just going to put that there. We've got a brand new gross profit figure, 31,385. Oh, sorry, that's not my gross profit margin figure, is it? Because that is not 25% of that, is it? It's just that. But it's sort of like a revised gross profit in a way. So now I'm just going to go through, basically just fly through these T accounts and putting in my income statement expense figures. So, fixture depreciation, 3,774. Insurance income statement figure, 6,540. Van depreciation, 3,436. Wages and salaries, 14,560. And as I said just a minute ago, I'm just going to throw the telephone payment figure in of 900, bringing my total expenses to 29,210. I'm just going to take that away from that profit figure, and I'm going to get 2,175, and that's it. I hope you're able to follow that easily enough. As long as you understand your T accounts and your basics, you're going to be absolutely fine with that kind of question. But anyway, I'll see you in the next video. I hope this uploads in 720p. I don't know what's stopping it doing that, but I hope it does work. And inventory valuation next video. So thanks for watching, and I'll see you guys in the next video.